Hello and welcome to Raise Your Average. I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Adam Butler of Resolve Asset Management Global. Our very special guest is Kim Shannon, founder and Co-CIO of Sionna Investment Managers, lead portfolio manager on Sionna's large cap, all cap, and focused Canadian value strategies, as well as co-lead on Sionna's high conviction strategy. In her journey as a portfolio manager and as a purist bottom-up value investor, and with the application of her proprietary take on value investing, she and her team turned one of Canada's oldest mutual funds, which at the time had $40 million in assets under management, into Canada's largest equity mutual fund at CI Investments, earning her a reputation as one of Canada's preeminent market wizards. In 2002, she founded Sionna Investment Managers to establish herself and her colleagues as independent investment managers in the domain of fundamental bottom-up value investing. It's noteworthy to mention that the last 12 years have been unkind to value investors and fundamental analysts. With value investing coming back into focus as investors set their eyes on quality, growth, competition, and risk, we couldn't think of a better guest than Kim Shannon to lead today's conversation.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
It's terrific to have you on Raise Your Average. Welcome.
Terrific. Thank you. Thanks for the beautiful introduction. I liked it.
You've had a terrific career and a reputation that precedes itself. Kim, to kick things off, for those of us who don't know you, please tell us about the arc of your career, your background, your experience, and what you're up to these days.
Terrific. Thank you. Well, I started in the industry almost 40 years ago. And it was a very different environment, you can imagine, than it is today. And certainly my path as a woman coming into even business, much less investing, was a little bit on the convoluted side. It wasn't a traditional career path by any stretch of the imagination. And it certainly wasn't a great environment for anyone to think about entering Canadian equities. Because back in the early 80s, we had interest rates that were at extremely high levels. And, why would anybody buy risky equities offering a 9.5% average return when you could roll T-bills at the time at 13%, which is what I did in one job back then. And so very few people entered equity investing, but the way the world works is often entering a field when no one else wants to enter it, gives you a clear and open opportunity set overall. And I started off in insurance, where I worked for approximately 12 years, managing internal insurance reserves. With some really great practitioners that really taught me how to invest. In particular, John D. Tomaso was an exceptionally good value manager, more of a cigar butt value manager than I am. I think that everyone has their own flavor of value based on their own personality, and I was wanting to add a little bit less risk in my portfolios for clients than John D. Tomaso was willing to do. And then I moved to an investment counseling firm to learn the craft of having external clients and interacting with external clients. Now, when I was at the insurance company, I'd started managing segregated mutual funds. So I'd entered the retail space and had a pretty good track record in those early days for seg funds. But, it wasn't until I was at this investment counseling firm, me and my partners, did I actually get exposed to both institutional clients as well as mutual fund clients. And I took over that mythical, the Canada's oldest Canadian equity mutual fund, the Canadian Investment Fund, which started in 1932. But had fallen on hard times with managers that hadn't done a great job for it and was down to 40 million. And through good stock selection skills and obviously a good market for value, really built the track record. And then I was lured away to go join Merrill Lynch in its second return to Canada, and built up their asset management, their retail asset management division in Canada. And 6 months later, my client, Spectrum United, followed me. And then we were eventually sold to CIBC. And within 6 months of that sale, my largest client, Spectrum United, was sold to CI Mutual Funds. And that's when the genesis of Sionna occurred. So back in 2002, I launched Sionna, and I launched it as a sole proprietor because, it was known that CIBC was fairly litigious. So didn't want to give them any reason to do that to me. Built up the firm, hired a bunch of young people and built up the firm. And now the firm's, this year will be turning 20 years old overall. So that's a bit of the career path, and along the way, I have to say the environment was also very different back then. If we talk about male, pale, and stale in asset management today, it was much more so that back then. There was very few women in the field. I mean, there's very few women in asset management today. The numbers are 1.5% of AUM are run by women today, and even fewer with women with senior ownership or founding of firms overall. But I think that asset management is a meritocracy. So I think back then it was even harder to get in. I think it's much more open, and people are very interested in building diversity in their organizations. But it is a meritocracy, and so if you're capable and talented and focused and motivated and interested, I think it's very possible to do well in the field today.
That was great.
Yep.
I'd love to hear how you talk to young women who are considering to come into the industry nowadays. So, I mean, obviously the industry's evolved, our culture and society and norms have evolved meaningfully over the last 20, 30, 40 years. But I mean, the industry is still the industry, right? So I'm curious, as you look at the state of the industry today, what kind of guidance do you give young women who, what are the trade-offs? What benefits that you talk to them about?
Right. I think it's very similar to almost any other professional services job. And when I say that, I'm talking about lawyers, accountants, medical professionals, engineers. It's that kind of field. You are dealing with clients. So I think there's a lot that appeals to women. It involves both sides of the brain, and for a lot of intelligent people, that's very, very appealing. So on the one hand, it demands the skills of being fairly analytical, fascinated by ideas. I personally don't think that it demands enormous mathematical skills. I think it needs rudimentary math in terms of, add, subtract, multiply, divide, and understands percents and relationships. That I think most intelligent people can handle. But I think that the other side of the business, and particularly in investing, it's about being very focused on people. And that's on the analytical side, because I think markets are as much driven by human emotions as they are by fundamentals. And I think when you come across investors that are just purely fundamentalists, I think they're missing a lot of the picture. Because why does the market one day, trade at euphoric highs, and then sometimes the next day trade at very, very depressed lows. I lived through October 1987, when the market fell, over 20% in one day. So you have to understand that that activity is possible, and it's not fundamentals that created that kind of change. But there's also a human side to the business. When you're interviewing management teams, the better the questions you ask, the more humanistic you are, the more comfortable you are with engaging a CEO or a CFO, and really can pull out of them what the drivers are in their business and get more frankness and less aloofness out of them, you'll get more information. And then there's the side of selling. Everyone has to sell. To get from being an analyst to a portfolio manager to a CIO to a founder of a business, you have to be a seller. So you're selling at so many different levels. You're selling yourself to your bosses, to your clients in order to get promoted, to get your job. And you also have to sell to your customers and your clients. So there's so many skills that take in the people skills, which I think women have a tendency to excel at overall. And I think it's very needed in the industry, because the profile of the average portfolio manager is that they're introverted, that they're very intelligent, they're very analytical, but that they're not as interested in communicating with clients. So to have that broad skill base leads to a lot of success in the industry. And so I think that it's a great field for women. And I think because a lot of the work does not need to be done in the office. A lot of it is about research, getting home, if you have children, I have a 22-year-old now. My daughter was 2 years old when I started my business. And, when you come home, you put your child to bed and you can do more work in the evening. I do have to say that the marketing across the country can be a bit demanding. And so, there will be a need, if you're successful, to have childcare. But the other side of this industry is it generally remunerates well enough to do so. So it all worked out for me overall. But I think in the end, it's about people finding a career that really suits their personality. And I have no question in my mind that this can be an excellent career for women.
It reminds me of my own daughter, who is 23 as well, and she, has exposure to finance, and she was given the opportunity to participate in a program called Girls Who Invest. So if there are some ladies considering this field, this program is by Seema Hingorani. I'm probably mispronouncing her name. But she's the managing director at Morgan Stanley Investment Management, and her finding was, I'm sure much like yours, sort of the only woman around the table, and they started trying to get young women involved in sort of the post-college, post-undergrad. So finish your undergrad now, come to the investment management world, and what they found was it was too late. And so the program is for young women in, sort of second year of their university or college, whether you're in the US or Canada. It's totally gratis, so it's paid for and funded. Obviously, there's an application process that's pretty rigorous. But what she found, and I found so interesting, is that it's not the math that prevents the women from entering the field. In fact, what happens is females who enter the field end up going the CPA route rather than the CFA route, to sort of summarize the angle. So they're capable in all the mathematical machinations. They're just uncomfortable a little bit with the male-dominated field to some degree, and the lack of sort of the support network and the leadership that they could look up to as successes that they could follow in the footsteps of. So, I would suggest that if there are some young women in those earlier years of university and they're considering this as a path, that they look into that program and make application to that. It is an expanding program, and I think meaningful in getting those, changing the mindsets early enough to make this career opportunity a priority for them.
Right. I think you've just hit the nail on the head, and I am familiar with that organization. It just started about 5 or 6 years ago. It's pretty impressive. But women need mentors. They need to be able to model after somebody that they can identify with. And when I entered the industry, that was a real challenge. But I did find some successful women, albeit not in the field, that were able to mentor me and encourage me and suggest how to make it work in their lives. So an organization like this will be critical in the early stages. And in Canada, we do have women in capital markets as well, which has been encouraging, throughout their entire tenure, that women consider fields in the finance field overall.
Excellent.
Yeah.
Go ahead, Pierre.
So, yeah, I think the business is, this is a business where, you really, like, I don't think you can get into, for example, retail advisory anymore, except under the wing of a senior advisor. And only because the way that the industry has gone, it has really migrated away from transactional, from commissions and into the fee-based realm, or it's at least it's in a major transition away from that transactional realm. And so, and to your point, Kim, which was that, you have to wear so many hats in this business. You can't just be the investment manager, the portfolio manager, or the advisor. You have to be a counselor. You have to be a marketer. You have to be a salesperson. You have to be all of those things that go to make a business successful. And when you're getting started, especially whether it's as a portfolio manager or as an advisor, you really do need to you really do need to be, you need to be all those things all at once, all the time. And so sometimes you end up being really good at one of those things and terrible at the others, or if you really set your heart on it. So that's why the mentor is very important, right? I mean, the mentorship is critical in terms of sort of demarking those priorities early on, as opposed to being either a really good, you could be a great salesperson and a terrible money manager. And, a lot of people have made it in the business, being that. But it's exceptional when you can be both a really great marketer and a salesperson and a great investment manager altogether. Yeah. Yes. And counselor and, a good listener and a good friend to your clients.
How have you seen the differences between dealing with, so your career has spanned a whole number of different relationships. And so I'm interested in what were your strategies as you walked forward in your career, moving from, sort of insurance captive, then to, a little bit more OPM or other people's money. And then also the OPM going to retail as well as to institutional. And what are some of the differences and the nuances that you've picked up when you're communicating with your clients that are slightly different in these domains? And how have you capitalized on those insights?
That's a really excellent question. And I also think it speaks to what an issue you raised earlier, which is that you have to start building the skill base earlier. And, there's lots of talk out there. The tipping point, I think, expressed it fairly well, Malcolm Gladwell, where he said, in order to be world-class at anything, you really should have been doing it for the last 10 years to get up to that level. And, when you look back, it's a lot of the volunteer work you did earlier in your career that built a broad skill base. And then you bring a problem-solving mindset into the game. And the industry is constantly changing. And so when you're facing problems, you end up dealing with them. Like for women back then, and I still think to some degree today, you're having to deal with the fact that people don't, there was a certain level of sexism and, a non-belief that you could go all the way. So you had to decide you were going to defeat that problem. And what kind of way were you going to defeat that problem? By working really hard and paying attention to what made other people very successful, and then trying to build that skill base. And you just keep pushing that envelope over and over again, and seeing solutions. Like, one career burden for myself was my organization was having a lot of difficulty making me lead portfolio manager. And I had read that one of the ways of inspiring a firm to promote you was to embarrass them by you becoming the leader of an industry organization. So I became the president of the Toronto Society of Financial Analysts. If the world was seeing me in a leadership role, it was a little embarrassing if my organization wasn't as well. And so you keep, noodling the problems and solving them. At another stage of my career, I heard that portfolio managers sat on charity investment boards and got to hire and fire external managers. And I had done a lot of board work my whole university career, and I'd always done volunteerism. So I decided, I worked at getting on those boards, and then I got to see what it felt like to sit on the other side of the table. And therefore it makes you a better communicator to that group. But I think it's about sensitivity, understanding, who people are. And so by sitting on other boards, you really get to see the communication, how to communicate better to those groups. And it's about understanding your client base, what their needs are, and speaking and selling to all those levels. As a portfolio manager selling into a major retail channel, the selling point is at so many levels. You are selling to the gatekeepers of the organization. You are also selling to a financial advisor that you are going to do well for their client base and not take on a lot of risk. And then ultimately, you're ultimately, a lot of things you're saying and doing, you're being very thoughtful about the ultimate end client and what they need and want, so that your product will be, attractive over a very long period of time. So those are all, I think, that problem solving skill and thinking ahead at all the stakeholders that you're addressing is part of that whole problem solving that leads to a successful career overall. And I have an interesting side story that I was a volunteer birth control counselor in university, and then as volunteer work afterwards. And I felt that the opportunity of discussing and helping young people decide what method of birth control suited their lifestyle the best was an early teaching for me about the sales role. And so, all those unusual experiences of volunteerism can all contribute later on to parts of the success of your career.
Amazing. And I don't want to miss out on the opportunity to dig into the whole value investing complex and that sort of stuff. So maybe we can shift gears now and jump into that side of the program. Yeah. And
I was going to risk the segue Alaxis to you and Cal in the selection of the companies in their portfolio.
Yeah. Well, that's one way to do it. I wonder if, yeah, sure. Let's go with that. Well, certainly there was a nice setup from Kim for sort of looking in the beginning of your career, the opportunity set now, And how have you spanned that arc as you've had to adapt value investing to remain successful and to continue to be relevant in this domain? And what are the challenges today versus then? And how are you approaching that, and get into the nuts and bolts? Because I think there's a lot of listeners that are going to want to know about that too.
Perfect. And it allows me to back up and hit on one of my favorite topics, which is financial market history. We have just, I hope, exited one of the longest and deepest underperformance periods for value. And the history of value versus growth goes back to 1926. There just isn't enough good granular data to be able to break up the market between value and growth prior to that time horizon. And this is the third major period of underperformance of value versus growth. But all the rest of the time, value has done better than growth. So the long-term history is that over 80% of the time, value beats growth. But when it doesn't, it's very painful. And it's natural because markets reflect human nature. And the pendulum of what is interesting to the market swings back and forth over time. Just like you see in politics, you go from political left to political right. There's so much in life that keeps flipping and changing. People want to try something different, and the world evolves a little bit and tests the other side of the equation. And so we've just had an incredible major growth phase, but it was the longest and deepest. And so, no one in value management has faced this kind of challenge that we are aware of in the past using this investment approach. And so it's been pretty brutal for the practitioners in the field. And a lot of us attempted to adapt by, moving a little bit more into quality, a little less rigorous on certain value factors. Price to book became a little less relevant, and partly due to some accounting changes that happened out there. And so a little less reliant on that, leaning a little bit more heavily on other investment tools, and just sharpening your pencil and hunkering down and trying to do, an even better job. And by getting less distracted, that helped in terms of focusing on the job. But, it does look like the pendulum wants to turn again. We have reached a bit of an extreme in valuation, and the market seems to have is heading back. And I'm, if you don't mind reminding me of the fullness of your question, because I segued out and I want to the core of the question.
I think you're answering it beautifully. And it's so that was then, and this is now. We've had this swing, and have you taken the opportunity to adapt? How is Kim Shannon and Sonoma approaching the challenges, and how have you adjusted, and how do you continue to remain relevant and competitive? And then maybe some of the secret sauce that goes along with that.
Well, maybe start with the sort of core framework, Kim. It's like,
Sure.
How do you think about value overall and valuing companies? And then maybe, contrast a few different kind of prototype value styles, where you kind of fit in, and then how your spin on it is a little bit different, why you think that those differences are important, and then how they've evolved over time in response to this wacky market environment we've been in the last decade.
Well, there's a lot of questions in there, so let's hope I touch on a lot of them. And partly it comes down to a philosophical approach overall, that value managers believe that the market is irrational. It's we can't possibly believe that the market is efficient. Otherwise, how would you be able to get excess returns from stocks overall? And we believe that from time to time, individual stocks will get too inexpensive, too cheap, well below intrinsic value. And we want to, own those stocks as long as the risk factors are acceptable, and then patiently wait for them to go back to intrinsic value. And I think the core belief that value managers believe vis-a-vis growth managers is that, growth is, more people intuitively understand growth, want to play with growth, buy the best firms with the biggest ROEs and the biggest earnings growth, but they generally are fairly expensive to own. And I've seen many studies in the past that show that, growth stocks do really well until they don't. And then they start to come down, and that when they do start to fall down, when the growth stops, when that growth really starts to roll over, the valuations can come down a lot and be very painful. So, you may have a growth manager doing a great job, and then suddenly it doesn't even have to be a value versus growth game. You just have one or two individual stocks in the portfolio that stop growing, and they really pull down the results. Where value investing is more incremental. You're buying stocks in aggregate that are cheaper than the market, and then slowly over time they crawl back up towards their intrinsic value fairly consistently, if you've done your homework well enough, and then get you the returns and do it with very low risk. And I think that style of investing, which historically has been reasonably consistent, and traditionally had provided very consistent returns to investors, that people were willing to give up some upside in the strong markets to do really well traditionally in the weak markets, and do it with less risk overall. And so that was the thesis and my belief system about value investing and why I was comfortable doing it. I think it also suited my personality overall and the team that I built. So that was kind of the underlying fundamental and thought process around value. You had multiple other questions there, so if you don't mind.
Well, you've said intrinsic value a few times, so maybe if you don't mind, dig a little deeper in how you define value.
Yes. Well, what we do is we start with a fairly quantitative model. We do screening at the beginning, and we run through a very crude calculation where we're looking at three key factors to determine what the value of a stock is, and then comparing it to the current stock price. So we're certainly looking for the earnings machine capability of the firm. But the three factors, I think, focus in on factors that interact. So I think it's a very useful tool, not for all stocks and not for all sectors, but for a lot of stocks in the marketplace. I would say at least 2/3. Most of the time, it's a very good tool. And it starts with book value. Now, book value is a little less important today than it has been in the past. I'm not willing to throw it out. I think that over time, when you adjust for some of the accounting changes, you can deal with it. But it's trying to capture the balance sheet of the firm, and a very low the changes in book value affect the multiple that you're going to give to the ROE. So, book value times ROE gives you earnings per share. And as a value manager, we're always trying to look for the normalized earnings, what's the center of where this stock's likely to go over time. And that's sort of a key element. So if book value gets destroyed by write-downs or gets inflated, it affects the ROE. So they ebb and flow with each other. You're still going to come out with the right normalized ROE over time for the firm, the earnings machine capability. And then we also use, when you're picking up ROE, you're trying to capture that earnings machine capability of the firm. And then the third key factor that we focus in on is relative PE. which I would call it a valuation multiple. And, keep in mind when I started in the industry, that was the early days of computers. And nowadays, technology is brilliant. You get on a fact set, you can easily, like that, get a 20-year number if the company's been around that long for their average and normalized relative PE multiple, how it's tended to trade relative to the market throughout its history. And that composite gives you a pretty good idea of an intrinsic value. But you do have to marry that with deep fundamental analysis, because numbers alone can trick you. And management teams are definitely motivated to put their best foot forward on their financial statements, and they're incentivized to do so as well. And so, investors have to be cognizant of that and spend a fair amount of time looking at accounting practices and choices. And it's all legal. There's a lot of variety of accounting choices a management team can use to demonstrate the results of their firm. And it's intended to give an industry group choice to use the most appropriate to describe what's going on. But like I said, there is an incentivization to put your best foot forward. So there is a fair amount of accounting work that needs to be done when examining firms. And there's also understanding the overall business, and then also judging the quality of the management. And then finally, also looking at the consistency of management over time. So by starting with a quantitative model, we're making our job easier, because we do produce the models weekly and look at how the names change throughout time. But it's also very useful in market schisms, where the market changes very dramatically, like October 19th, 1987 or 9/11. Major market moves, you just immediately reprint that model, and it gives you a really good sense of where you should be putting your research really fast to take advantage of that opportunity set that's suddenly come out. So that's the benefit of using a model. But in terms of our fundamental research, we actually, to add some rigor and discipline to it, we use a very structured questionnaire template. And there's a number of sub-questions underneath each one. And it allows us to train new analysts. And we start off by using that template to help us do the research process and write written research reports and discuss them collectively in our team, so that we can get a consensus view on a name in order to put it in the portfolio overall. So that's, so first we use the quant method to identify what's cheap and focus our energy. We write this, we fill out the questionnaire template, write a research report, and then as a team collectively decide. I also have to mention that there's some stocks that don't quite fit the model, and yet you should be looking at them anyways. Like a number of resource companies, you're better off looking at NAV and trying to find stocks trading below NAV rather than the calculation I mentioned earlier. So depending on the industry, and I think that's the beauty of active management, depending on what's going on and depending on the industry group and the fundamentals and the point in the cycle, you can use you can use your judgment to decide what features to really focus in on, to decide what is the ultimate candidate to go into your portfolio. And I think the other major component of investing is portfolio construction. And we sit down for 5 hours once a month to go through the portfolio and try and look. We use a number of exercises to try and look at the portfolio from multiple angles, because in every single day, the market prices are moving and the relative positioning of stocks are moving within your portfolio, and their weightings within your portfolio are moving. And from time to time, if you didn't have that discipline, you'd lose sight that a stock had become overweighted relative to its opportunity set or shrunk. So that's another important tool is portfolio construction, where we're sitting down and making sure that at all times the portfolio reflects our current view on what is going on overall. And so that's kind of captured very quickly the philosophy and the core elements of our process in terms of building portfolios.
So am I right that maybe you would normally sort of stay away from companies in certain sectors, like maybe, for example, financials might be a little bit harder to evaluate in that framework, tech, maybe a little bit harder to evaluate in that framework. As you mentioned, resources, you kind of need to attack from a slightly different angle. So how do you think about that in general?
Yes, that's a really good question. And here in Canada, we use what we call relative value investing, which we think is very pragmatic for the Canadian marketplace. All markets are idiosyncratic. There's 11 GIC sectors out there, and no market has 9% of their portfolio in every single sector, and that's the perfect portfolio. Every market has sectors that they are good at, and they're a big part of their index, and there's other sectors they're not as good at it economically, and they have smaller weights in their sectors. And viva la différence, Ricardo's law of competitive advantage suggests that what you're good at, you do more of, and what you're not as good at, you do less of. And so part of that relative value is, our Canada is accused of being too overweighted in financial services and resources. And because of that, we're considered a very cyclical market overall. And some people will say Canada should be underweighted because it's too idiosyncratic. It must be, a lower returning, riskier market. But the data from Dimson, Marsh, and Stoughton going back over 100 years suggests that's not true. We're one of the better performing markets with lower risk. So, we could put that to rest. But as value managers, from time to time, we will be drawn to certain sectors as being extremely cheap. And if you were just drawn to the names that were cheap, you would overweight those sectors when they were super cheap, which could add a lot of risk to your portfolio, and then underweight the sectors that are very expensive. And so we adopt relative value investing, which means we try to be plus or minus 5% sector weights in all strategies, in all the sectors across the fund in a lot of our strategies. Not all of them, but quite a few. And we find that it's very amenable for the Canadian marketplace because we won't be too exposed in commodities at any point in time. And plus or minus 5% is very constraining for the major sectors like banks and energy from time to time. And what we find is that it leads to more consistent results and lower risk overall. But you'll find that a deeper value manager, which follows the market, will from time to time have really divergent returns relative to the market, and that's not appealing to all clients. And so that's why a lot of our core strategies focus in on relative value to minimize portfolio risk overall in the Canadian marketplace.
So does the high conviction strategy then allow for a broader bandwidth in those restrictions?
Absolutely. Thank you. Because, it's taking on a little bit, it's much more concentrated, and we are benchmark agnostic. So we will take on more risk overall. We'll go where we really think our best ideas are. We run 10 different strategies here at Sionna. So in terms of best ideas, it has to be in the other. If it's a high conviction strategy, it has to be in one of the other funds to be in a high conviction strategy. So we're kind of limited in what we can look at for but they're all been well vetted. So it's really about what do we find most appealing in the marketplace overall.
And I guess the
That
investor,
creates a little bit more opportunity. But, most clients who go into high conviction strategies are well aware that they're going to have iron stomachs from time to time. And certainly in the last year or two, that was needed. But, we all know the market has changed recently. And, it was a little bit bouncy, the value opportunity coming back. But certainly since the beginning of this year, it's been much more pronounced. And, we've been delighted to see the subsequent results.
yeah, you have to be prepared for the tracking error, I suppose. Go ahead.
One of the things I wanted to bring up was that along with the rise of ETFs and passive investing, has been a rise of systematic value or quantitative value investing, which is really more of a top-down approach to investing in value or investing in the value segment of the market. But that, I guess what I wanted to do was ask you, like, how would you differentiate, how does what you're doing, Kim, as an active value investor differ from what a lot of people have come to think is value on the quantitative side? Because it struck me as two very different things. You call yourself a value investor, and people investing in quantitative value strategies consider themselves investing in value. So how do the two approaches differ in your mind?
Well, as active managers, you have that opportunity to really examine risk probably a lot more. And you're spending more time, weighing the nuances embedded in financial statements or management quality, or consistency of returns to decide whether you want to be in that name. I mean, one of the biggest challenge for value managers is what's called value traps. And I'm not that familiar with, what quant strategies do entirely, but I would be very curious, how do they deal with so-called value traps? We know that, we actively want to avoid value stocks with lots of financial risk. That's a really good start in terms of avoiding real challenges in value traps overall. Because if you're in cyclical business with a lot of debt, it's a very painful experience from time to time. And that's a choice that management gets to make.
You want to avoid buying stocks. You want to avoid buying stocks that are cheap just because they're cheap. Obviously, you don't want to be, which is the value trap, where you're you're buying something that's cheap because it should be cheap, as opposed to cheap because it's actually worth more than you're able to buy it for. But so again, that's a very subjective methodology, but I think that has a lot to do with, on the quantitative side, maybe that has a lot to do with the sort of use of price to book as a guide, which in itself is and
which is not as useful a tool at the moment in the marketplace as it has been. Now that may well change, but I mean, for example, early in my career, you could do charts of the market, and you could do two lines around that market return. And the upper one was when the was price to book, and the lower one was 0.75. And 80-90% of the time the market traded between the two. So now we have the market trading, significantly above book all the time. And it is only occasionally you get a chance to ever buy a stock trading below book overall. Much less so than in the past, for sure. So it's a different tool than it used to be, for sure, overall.
Well, I was going to ask if maybe you might avoid, as a systematic value investor, some of those value traps by
we can't hear you.
Also screening for some quality factors, maybe low leverage, low investment, low earnings variability, low market beta, high return on equity, that kind of stuff. And, once you sort of screen out, let's call it what AQR might call the junk, right? Then you can zero in on those higher quality companies that maybe are trading cheaply. And then there's probably more work to do either on the forensic side, digging through how management chose to account for different items, going through the footnotes and, seeing whether they've taken some liberties with certain other different accounting items. So it just is a function of really maybe using more diverse criteria the field, and then really get the microscope out and apply some of the more forensic and subjective or qualitative type of rigor that you would apply as an overlay. Is that a fair position?
I totally agree with everything that you've said. And I would call that good quality risk management as well. How to avoid losses. And if you're buying an index or an index-like product, or just buying it on the surface of a couple of factors, all of that variety of factors that come into play about how you get off the fence and decide, are the risk factors acceptable enough to take on this opportunity for reward. I mean, that's you're touching on that core crux of all investors investing, but particularly value investing, because when we're buying stocks, they're not easy to own. They're ugly. When we're buying them, they are so cheap. They've got problems. They've got challenges. That's why they're inexpensive. They shot themselves in the foot some way. There's a cyclical problem. But you believe that they're going to recover from that and come back. And that's why you're entering that stock overall and you're taking that chance. It's through that analysis, you're going to come to that conclusion and put that in the portfolio or not, because there's that precipice where you're sitting on the top and you're going, I so want that reward. It's so fantastic. The expected return is amazing. And we're getting some large cap Canadian value stocks, like Manulife, with very rich expected returns on the one side. But on the other side, you can scare yourself on any stock with the potential risks. And how do you get off the fence and decide, I'm willing to take the risk for the reward, and I think I'm going to be paid for it. And that's probably one of the hardest things any fund manager does, because we know very well from past experience how painful it is when you have a stock that doesn't deliver or does very poorly or doesn't do what you expect. You do want to avoid the losses are loom very large in your psyche. So you're going to do a lot of work to make sure you're quite protected on the risk side so that you can get the reward.
Okay. I'd love to give you an opportunity, and Pierre, I'm sorry if you're also talking. I actually can't hear you.
No, go ahead.
Strangely, but I'd love to give you an opportunity to sort of give us an example, maybe without naming names of companies or management, of where you were able to tease out some critical risk or potential reward information from applying some of those softer skills. Maybe it was interviewing management or some items that you noticed in their financial reporting or have you, but just some examples or one or maybe two examples of where that was really helpful and where maybe quantitative screens may have missed those.
Well, I think it may not hit that one quite on the head, but recently in Canada, we've had and still is today, energy stocks were incredibly inexpensive, and the market was avoiding them because of the perception that there was a tremendous amount of risk out there because of ESG, and that a lot of global investors were avoiding investing in Canada and investing in Canadian energy. But by doing enough fundamental research, we felt that the market, the desire to move towards ESG was so great that had overlooked some of the challenges of getting there too fast. And that, the supply demand equation was such as that demand was growing in such a way, and that if you looked at the alternatives that were coming upstream, they just couldn't be delivered fast enough for the lack of supply that eventually was going to hit the market. And we're starting to see elements of that showing up in the marketplace now, and we've seen a repricing of the underlying commodity and the early phases of a repricing of the sector overall. So that would be one of the more recent dramatic examples of that overall. But, there's also moments when you own a stock and they've suddenly taken on significantly more debt, and you may be long that stock, and you decide that you're going to take your weighting down substantially because the risk factors have changed very dramatically.
Right. So sometimes you will have, or your team will have, maybe of certain macro risks that maybe the market is mispricing, and you're looking at the value of companies in a certain sector that maybe are pricing in a different range of macro outcomes than your team is anticipating, and from there may be a substantial gap that is not revealed by simply looking at the accounting metrics.
And, we've been criticized in the past for not owning some of the more expensive names in the marketplace, like Valiant or more recently Shopify. And, the fundamental analysis is that, like more recently Shopify trading at over 300 PE multiple, history suggests that, the average stock has a tenure today of less than 20 years. And if you look at the top 10 stocks from 2000, the market peak, only 2 of them have ever gone back to their market cap highs from back in 2000. And, the implied earnings growth embedded in very richly priced stocks are rarely delivered in the marketplace. And so we get challenged by clients when it's extremely painful, like the summer of 2015, when Valiant was, 120% of the index return in the third quarter. And by not owning it, by the fourth quarter and thereafter, we did extremely well by holding our guns against the challenge. And as we're not starting to really see happening today around Shopify. Shopify, I think, is a very interesting company. And as a Canadian, I would love to see it thrive. I just think that the expectations for earnings growth are so high at the current PE multiple that history suggests that it's unlikely to be able to be sustained. And that's that would give you an example of a stock today where we have a variant view on what is going on with that stock, even though you think it's a great business model overall.
And we're shifting from maybe a growth-oriented regime to a value-oriented regime. I think everyone on this call actually would benefit from that shift. But we're also, I think, maybe on the precipice of shifting towards a more inflationary regime. I'm just wondering whether you're seeing this effect bubble up from sort of a bottom up analysis in your portfolio, and or whether you're also trying to steer the process a little bit towards a view that we may be entering a more inflationary cycle?
Well, it can and does ultimately impact your overall market PE multiple that you would apply in your overall in the fundamental model overall. So yeah, inflation is a big factor, and when I started working with the model early in my career in '86, we were using the overall market PE multiple was more modest than it is being used today, because there was higher inflation back in the '80s than we are today. It turns out that inflation is actually good for two key factors for Canadian investors. One is that value is very good. Inflation is really good for value. And here in Canada, Professor Hassan Asakas at the Ivy School of Business, the Ben Graham School of Business, he, in conjunction with another colleague, wrote a great article about going back to the 1930s, rolling value versus growth and rolling 3-year records, that when inflation is a mere 2.5% or better, which clearly we're in that camp today and may well be for a couple of years here, that value tends to outperform growth by 11% per annum. So, a very good environment for value. And I think that's partly why we're starting to see value do extremely well, as we've had an incredible inflation number. And as people have come to realize that inflation is not temporary, but, is starting to affect more permanent factors like wage growth. And it's really hard to roll back wage growth overall. So, we're starting to look like we're in the beginning phases of inflation as well, since, we haven't had inflation in any material way. We've had disinflation since 1981. So that's 40 years. We've been knowing there's going to be this paradigm pricing shift. The pendulum is swinging, that maybe it's now. So it's changing the valuation in that direction. The other one is looking back from the 1970s, there was 5 periods of inflation in Canada. The National Bank did that survey and showed that Canada did much better than the US in terms of being a decent inflation hedge. And so we are of the opinion that, the Canadian market is likely to do well going forward, partly because it's so inexpensive and has an above average dividend yield, and that Canada tends to be a better inflation hedge. And you could sort of argue, almost from a fundamental perspective, being more resource commodity orientated than the US, that we would benefit from inflation. And certainly when you look back in the 50s, the post-war era, when there was inflation, Canada did outperform the US. So those factors coming into play to the benefit of value managers overall. So that's fairly encouraging. Plus, the 3 factors together suggesting it's good for Canadian value managers in particular.
I guess it's also, adding on top of that, you have those large growth companies who have dominated this growth-oriented market, who benefit from the disinflationary side of it. And now you've got, on top of the potential, the valuation effect on inflation, but then you've got the money flows that come from those growth investors who will, potentially be disappointed over the next number of quarters and years. And those money flows are going to probably head towards where money gets treated best, as money does. It will start to realize that those discounted rates of growth going into the future, when you increase the, discount rate, all of a sudden that lowers those expectations, and now you're headed to areas where you're seeing resource influences that increase the expectations coming from very low multiples.
Right.
So it seems like the table might be set for, hopefully another decade or two of this reversion for value back to trend and growth back to trend.
Exactly. When you look back in history, particularly the recovery in the early 40s, which as well was a movement from a long-term disinflationary period to the beginning of an inflationary period, you had a very dramatic turn back from growth to value. And the first 3 to 5 years was one of the best outperformance periods. And you've seen it as well in the past, in 2000, this great comeback for value after, when the high flying tech stocks, the .com stocks came down. So yes, I agree with all of your comments.
And I think the 40s are a particular interesting time because it's not just inflation, it's inflation volatility. So there's a base rate of inflation, but then there's a volatility around that, which since 1990 has been insanely low. We have had inflation volatility running at about 1.3%. AHL Managers have written a paper on this, whereas inflation volatility pre-1990 was at about 4.8%. Now, this is not inflation, it's the inflation of volatility. So how much is going up and down and the surprises. And what's so interesting about this 40s to 50s period where we were coming out of World War II and price controls were being removed, what was happening is you had these spikes in inflation. It wasn't like the 70s where it was this just increasing sort of inflationary pressure. It was a spike and then an abatement, or a sort of a new level, and then a spike and a new level. And, so you get this inflationary volatility that's at play, as well as just the base rate of inflation, which I think has some really interesting implications for changes in leadership when it comes to, sort of growth versus value, as an example.
That's really that's really interesting. Actually, that's like that's really I've been hearing a lot about the 40s analog for today, but that's a really interesting point, is Mike, which is that we're seeing the same kind of inflation volatility today, aren't we? With the supply shocks and the, it's a really strong echo.
Yeah, and as Kim points out, right, that wages don't regress. I mean, once you go up in wages, that's not an easy thing to say. Oh, we're going to cut your wages today. Yeah, that dog's not going to hunt. Anyway, Kim, it's been an absolute pleasure to have you on, and I think we have covered just an enormous swath of topics, from women in investing to value to the current circumstances. It's been an absolute pleasure. I'm wondering if you can also let people know where they can find you, if you're on any kind of social media, whether it's LinkedIn or Twitter, your website.
Yeah, we're on all of the above, of course. And Sionna.ca is how you can get to us more directly overall. So thank you for that opportunity.
Yeah, thank you, Kim. It's been a pleasure to talk to you today.
Thank you. Great questions. Great fun.